Many NRIs return to India, assuming the difficult part is over. You have packed your bag, moved back, and now all that left is filing a few tax returns. But the first financial year after your return is usually the most expensive year to make tax mistake. Because this is the year your Indian residency changes, your US investments and bank account may become reportable, and one poorly timed decision can cost you several lakhs in unnecessary taxes. The frustrating part is that you usually don't realize you have made the mistake until months later, when you are filing your returns or you receive a notice. In this video, I will walk you through 5 costly tax mistakes I repeatedly see NRIs make, and most importantly, how you can avoid them. I am Varad and I help US-based Indians make smarter financial decisions before and after returning to India. The first mistake is assuming you become an Indian tax resident the day you land. And that's not how it works. India determines your tax residency using day count rules and its financial year, which runs from April to March and not calendar year. That one distinction changes everything. Why does this matter? Because your residential status decides what India can tax. An NRI is generally taxed only on Indian income. And RNOR gets a valuable transition period where most foreign income remains outside Indian tax net. A resident and ordinary resident, which is ROR, is taxed on worldwide income. Imagine someone who have lived in US for 15 years and moved in September without checking the rules. They report all their US investments in India, and later they discover they actually qualified as RNOR and may have paid tax that wasn't even required. The other side is someone assumes they are still an NRI, files accordingly, and later finds out that they had already become resident for tax purposes. The lesson is simple. Before you think about investments, withdrawals, or tax planning, first determine your residential status correctly. It is the foundation of every other decision you will make after returning to India. The second mistake is confusing taxation with disclosure. Many NRIs returning think, I didn't earn much income from US accounts, so there is nothing to report. Unfortunately, that's not how cross-border taxation compliance work. Depending on your residential status, your Indian tax return may require you to disclose your foreign financial assets, including US brokerage accounts, US bank accounts, retirement accounts like 401k IRA, and other overseas investments. Notice the word disclosure. This does not necessarily mean India is taxing those assets. It simply means the tax department expects you to report them correctly. Now imagine someone who has 2 US accounts, a brokerage account, and a 401k. They do not sell anything during the year, so they assume there's nothing to mention in India. Months later, they discover the issue wasn't income, it was missing the disclosure. Another common misconception is that filing US forms automatically covers Indian reporting requirements. It doesn't. The US and India have separate reporting systems. During the transition year, you may need to comply with both. The easiest way to avoid this mistake is to prepare a complete inventory of every US financial account and investments before your first Indian tax filing, because you cannot report what you have forgotten. The third mistake is probably the most expensive one on this list. I am of course talking about RNOR period. For many NRIs, returning after spending several years in the US, RNOR creates a short transition window where most foreign income is not taxable in India. That window typically lasts for a limited period, in some cases 2 or 3 years. And once it's over, you can't get it back. Now imagine you have built US investments for last 15 years. It has significantly appreciated and you haven't sold anything yet. If those investments are sold during the RNOR period, the Indian tax outcome can be very different compared to selling them after you have become resident and ordinary resident, that is ROR. The same principle can apply to dividends, rental income, certain retirement account withdrawals, and other foreign income. The details depend on your situation, but the larger point is this: timing matters just as much as investment itself. Unfortunately, most people don't plan around this window. They return to India first, settle into new routine, and only meet tax advisor after some months or a year. By then, many planning opportunities have already disappeared. This is why I often say that your tax planning should begin before your flight back to India, not after you have unpacked your bags. because once RNOR clock starts, it's already counting down. The fourth mistake is closely connected to RNOR window. Most people know they eventually want to bring money back to India. What they don't realize is that when they sell their US investment can just be as important as what they sell. Let's take a simple example. Suppose you have invested in US stocks and ETFs for several years and they are sitting on large unrealized gains. You decide to sell them after you move back because you now need money in India. Sounds reasonable, but depending on your residential status, that exact same sell could have very different tax outcome. Selling before your move, selling during the RNOR period, and selling after becoming a resident and ordinary resident can each produce different results. The biggest mistake is making this decision without looking at both tax systems together. Many NRIs only calculate US tax they will pay. Others only think about India. In reality, it's dealing with two countries, two tax systems, and a tax treaty that sits between them. That's why this isn't just an investment decision, it's a cross-border tax planning decision. Instead of deciding what to liquidate after returning, build a simple liquidation plan before your move. Decide which assets should be sold before leaving the US, which ones may be better sold during the RNOR period, and which investments you can continue holding for a long term. A few months of planning can save far more than years of trying to fix the tax consequences later. And finally, let's talk about the mistake that brings everything together. The fifth mistake is the one that ties everything together. Many returning NRIs hire a CPA in the US, a CA in India, assuming each professional will take care of their own country's tax return. The problem is that very few professionals are looking at the complete picture. And that's where double taxation, mixed credits, and expensive mistakes begin. Remember, moving back to India doesn't always end your US tax responsibilities. If you are a US citizen, you will generally continue filing US tax returns regardless of where you live. Green card holders may also continue to have US filing obligations depending on their status. Even if you have left the US, you may still have the US investment income, retirement accounts, rental income, and other reporting requirements. At the same time, India expects you to report and pay tax according to your Indian residential status. Thankfully, India and US have DTAA, Double Tax Avoidance Agreement. Its purpose is simple: to make sure the same income isn't taxed twice. But that treaty does not automatically work. You have to file the right forms, claim the right tax credits, and coordinate information between two tax returns. Imagine you pay tax on the investment income in the US, but forget to claim the credit available while filing in India. You have not broken any law here, but you have voluntarily paid more tax than you actually owed. This is why cross-border tax planning is very different from preparing two separate tax returns. The US return affects the Indian return. The Indian return affects future US filings. Every decision is connected. This is why I strongly recommend working with advisors who understand both systems, or at least professionals who actively coordinate with each other. Because once both returns are filed incorrectly, fixing them usually is far more expensive than getting them right at the first time. Let's do a quick recap. So before you file your first tax return after moving back to India, remember these 5 mistakes. First, determine your residential status correctly. Every other tax decision depends on it. Second, don't confuse taxation with disclosure. Your US financial accounts may still need to be reported even if they haven't generated much income. Third, don't waste your RNOR window. For many returning NRIs, it is one of the biggest tax planning opportunities they will ever get. Fourth, don't sell US investments without considering timing. A few months can sometimes make a significant difference to your overall tax outcome. Fifth, don't treat US and India tax as two unrelated exercises. Cross-border planning only works when both sides are coordinated. Before you file your first Indian tax return after returning, confirm your residential status, including whether you qualify for RNOR, inventory of all US accounts and investments you still own, and review the timing of major sales or retirement withdrawals. Then make sure your US and India tax filings are coordinated so you meet all disclosure requirements and do not pay more taxes than required. Returning to India isn't just relocation, it is a tax transition. The biggest mistakes don't happen because people are careless, they happen because the rule change. Two tax systems starts interacting, and most people don't realize that planning should begin way before they have decided to move and not after. If you are planning to return to India within the next 12 months and you have US investments, retirement accounts, stock options, or property, this is exactly the kind of planning we help families with every day. We have also put together a first year tax mistakes checklist that summarizes everything in detail in this video. You can download it using the link in the description, and if you would like our team to review your situation before you make this decision, you can also book a consultation using the link below. Thank you, and I'll see you in the next.